You take the long position at support. The setup looks perfect. Then, suddenly, a massive red candle shatters through your stop loss, liquidates your margin, and instantly reverses back to the upside. You just became exit liquidity. Retail traders are currently hemorrhaging capital. These localized rejections function as deliberate market maker traps. They are engineered moments of high volatility intended to shake out weak hands before a directional move. These sharp, sudden pullbacks serve a singular mechanical purpose: to siphon liquidity. By forcing the price down fast enough to trigger panic, institutions force retail traders to sell at a discount right before the actual breakout occurs. Welcome to Crypto Whale Radar. By the end of this session, you will possess the data-backed strategies required to identify these liquidity sweeps in real time and trade the institutional bounce profitably. Distinguishing a structural market maker trap from a genuine trend reversal is the primary requirement for surviving the current chop. Let's look at exactly how they are pulling this off. To understand what is manipulating Bitcoin right now, we have to look outside of crypto. In the current immediate timeframe, Bitcoin is heavily tethered to the intraday momentum of the US stock market. Look directly at the S&P 500 correlation data. Over the last several trading days, a distinct timeline has emerged. In the pre-market hours, equities experience a sharp, localized dip. This pre-market drop acts as a spoof, triggering sell orders from crypto traders who anticipate a wider market crash. This split-screen visualization tracks exactly how this trap closes. On the left, the S&P 500 dips sharply in the pre-market. On the right, Bitcoin mirrors the drop. But the moment the traditional market opens and the S&P snaps back up, it acts as a slingshot, dragging Bitcoin right back into bullish territory. If we trace this slingshot effect down to Bitcoin's exact 4-hour chart, you can identify the floor. This 65.5K support zone is the wall that repeatedly absorbs these pre-market equity shocks. Even with bearish divergence looming on the macro weekly and 3-day charts, this micro 65.5K zone has held its structure. It absorbs the panic selling and stabilizes the asset for the reversal. This creates a blind spot. If you are analyzing Bitcoin's 4-hour technical indicators in isolation, without tracking the US equity opening bell, you are trading on incomplete data. You will short the exact bottom of the spoof. Mastering this equity correlation framework allows a trader to step back, let the retail market panic during the pre-market hours, and accumulate at the point of maximum intraday fear. Now that we have established the 65.5K baseline support, we need to map the immediate upside targets. Where does the price go once the slingshot releases? To find the target, we follow the heat. This chart maps the current liquidation levels. Look directly above current price action. Sitting precisely in the band between 69.3K and 69.5K is a massive cluster of short seller liquidations. As long as the S&P 500 maintains its current relief bounce, market makers are mathematically incentivized to push the price upward to sweep this specific liquidity block. The trapped capital is the path of least resistance. This 69.5K sweep is a localized hunting mission on the 4-hour timeframe. It is a grab for immediate liquidity before the next major structural decision. Short-term traders must align their positions with this magnetic pull towards 69.5K. Fighting this intraday momentum based on an outdated weekly chart bias increases the risk of being liquidated against the local trend. This trap logic extends directly into the altcoin market, specifically Ethereum. An aggressive rejection at the $2,200 level serves as a primary indicator of a strengthening bullish technical structure. Over the last 48 hours, Ethereum has marched upward only to face a textbook rejection out of the critical 2150 to 2250 resistance band. Retail sees this as a sign of weakness. Let's break down the actual geometry of what is forming here. This minimalist chart illustrates Ethereum's 4-hour price action. We have a clear left shoulder, a defined deeper head, and right now the price is dropping to form the right shoulder. This is a massive inverse head and shoulders pattern under construction. The $22,000 rejection was technically required to carve out the descending angle of the right shoulder. Without that rejection, the geometry of this bullish pattern would be incomplete. But there is a mandatory invalidation level. To validate this structure, Ethereum must find a hard bounce precisely within the $2,000 to $2,030 support window. If it drops below that, the thesis is void. If that $2,000 support holds and the subsequent bounce breaks the 2.2K neckline, it triggers a high probability bullish price target based on the depth of the head. You do not trade the middle of this formation. You wait for the structural confirmation at the neckline. Entering early exposes you to the chop of the shoulder formation. Treating every single resistance rejection as an automatic short signal blinds you to these compounding structures. Market makers paint these rejections to shake you out right before the real pattern completes. Executing these 4-hour localized bounces at exact support zones is a game of margins. It requires zero latency execution and high order book liquidity to avoid slippage. This is why I rely on BingX to front-run these market maker liquidity sweeps. It provides the precision required for this specific playbook. If you are ready to trade these setups, use the referral link below. It secures you competitive platform deposit bonuses and provides one-on-one trading mentorship access directly with me. Now, look at the rest of the altcoin sector. Right now, Bitcoin dominance is grinding sideways. That flatlining dominance creates an environment where capital can flow into altcoins for technical relief bounces. Take XRP. While defending its critical 1.30 support floor, it is actively extending a 4-hour bullish divergence, printing new higher lows on the RSI despite the choppy price action. Solana is flashing the same signal. It absorbed a localized dip into the $75 to $80 support zone and simultaneously printed a new higher low on its RSI divergence chart. Executing these setups on a precise exchange helps mitigate the risk of getting caught in market maker chop. It allows you to enter at high probability support levels with minimal execution lag. Let's zoom out and lock in the rule for this session. A disciplined trader never confuses macro consolidation with a micro trend failure. Here are the 3 critical levels for today's session. You're watching 65.5K on Bitcoin, the $2,000 threshold on Ethereum, and the $75 floor on Solana. Let the localized liquidity pools dictate your short-term entries and exits. Ignore the noise of the weekly charts while trading these 4-hour patterns. If you want to track institutional capital flows in real time, hit the subscribe button to Crypto Whale Radar right now. This data is your primary tool for navigating market manipulation. But listen carefully. Bitcoin has historically held a -0.8 correlation with the US dollar index. If the DXY breaks its current resistance and moves higher, the dollar's strength will drain the liquidity supporting these crypto setups. This correlation makes the DXY a primary threat that can instantly invalidate our technical thesis. Click the video on your screen right now to watch my masterclass on DXY correlation and protect your positions before the dollar makes its next move. See you there.